Today, it can be so difficult to buy a house. House prices have shot up and homes are super expensive. Probably more expensive than they should be. I mean, if you think back to the 70s and even the 50s, buying a house was maybe 1 or 2 times your annual salary. Now, if you buy a house, it could be like 10 times your annual salary. It's crazy. So, you still want to buy a house, what are you supposed to do? So in today's video, I'm going to go through a bunch of things that you can do to afford a home, or at least how to make a home more affordable. Okay, so if you want to buy a house, especially if you're starting out, there's a couple things you got to do. Number one, you got to get a down payment. You need enough of a down payment so that you can actually get a loan so you can buy the house. Number two, you're going to have to qualify for a loan. And then number three, you're going to have to pay for the loan and pay for the upkeep of the home. It's pretty much that simple. Down payment, get a loan, and then keep being able to pay off your mortgage and pay for the upkeep of the home. So if you have $30,000 saved for a down payment, but you really need $80,000, where should you get that extra money? You should loan it from your friends and family. And when you do that, you should set it up as a formal loan. You should write up some documents, write some stuff down on paper so that everything's in writing so people have clarity on what exactly they're going to get for their money. And I suggest that you use the same interest rate that you would if you got your mortgage. So let's say you got your mortgage and your mortgage is like 3.1%. Well, that's the interest rate payments that you would use to pay off your loan to your friends and family. The next thing that you have to agree upon is what the term of the loan is. So if you loan money from your parents or your in-laws, how long are you going to pay that back? Is it 10 years, 15 years, 30 years? Now, I would recommend having a longer time period. You can always pay things off earlier, but if you have a longer agreement, say like a 15 or 30-year agreement, you can always pay things off faster. But with a 30-year agreement or a 15-year agreement, those interest and principal payments to your in-laws are going to be lower, and it's going to enable you to continue to make those payments even if you run into some bumps in the road, or you lose your job, or you have some issues getting enough cash. So when you're looking at how to calculate those payments, you've got your interest rate, you've got the term that you're going to pay it back, how long, and now you need to figure out what those payments are going to be. So what you can do is you can go to like a Google Sheets and you can use a payment formula, and you can put in your current value as your loan amount, so to say negative $50,000. Your future amount would be 0 because you're going to pay it all off. Your interest rate would be the interest rate, that you're going to pay for your mortgage, say, 3.1%. And then finally, the number of periods would be the number of months that you're going to pay it off. So if you had a 30-year loan, that'd be 30 times 12 would be 360, so 360 payment periods. And that should give you your payments. You can also calculate just your interest payments, and you can also calculate just your principal payments. If you wanted to do those separately, there's separate functions for those as well. So now once you've gotten that down, you can write it down. You're going to say, this is going to be our term, this is the number of periods, this is how frequently I'm going to pay you, and this is how we're going to calculate what each payment is, right? And you can refer to the formula you use in the spreadsheet, or you can just refer to a fixed monthly payment, part of which is interest and part of which is against the principal. And then you're going to have to keep track of what the principal balance is, because as each payment goes by, your principal is going to get lower and lower and lower. So you're going to have to agree upon how you're going to communicate that and how you're going to post it so there's clarity, so everybody agrees on that amount. And the last thing is, you want to make sure that there's a way for you to pay off your loan early, right? So you want to make sure that any extra payments are counted against the principal. Extra payments not counted against future payments of interest, right? So if you have that clarity, right, your term, your interest rate, the amount that you're borrowing, right, you're going to get your monthly payments. And then from there, right, you need to keep track of your principal balance that you have lended between your friends and families, how much you owe. And then lastly, you're going to need to be able to communicate what that principal balance is on a regular basis, say monthly or quarterly, so there's no confusion. And just make sure that there's a way to pay back your loans early. Now, some of you may not want to loan money or borrow money from your friends and family. And in that case, you don't really have a lot of options. Sure, there might be places that you can get, zero down or zero interest rate payments, but I wouldn't recommend it. You'd have to look very carefully at those loans and make sure that they're not predatory loans, that you have a way to refinance, and that the lender's going to treat you with respect and not just try to foreclose on your home if you have any problems or any hiccups that occur. Also, a lot of times when you do get those types of loans, they're just sold off to another loan company, and so it can be tough if you run into any hard times, contacting who you need to contact in order to pay off your mortgage. You're better off having a down payment and going with a more reputable lender who's originating the loans as well. Now, if you don't want to borrow money, then the only option you have left is to sell stuff. So just look at everything that you have and sell as much as possible. Sell your cars, your clothing, anything that you've got, in order to raise more money. And that money that you raise is probably going to be your limiting factor in terms of how large a home that you can actually purchase. So if you can't raise that much money and you're stuck with that $30,000, that's the most you can afford for a down payment, then you're going to have to downsize your expectations. You may no longer be looking at a home. You may be looking at a condo, which has pluses and minuses to it, but you're looking at a smaller space overall. Okay, so if you're able to loan money from your in-laws, how are you supposed to, or your parents or your friends and family, how are you supposed to explain that this is a good investment, right? Well, here's what you got to do. The second part is you got to figure out, right? You got to get your mortgage, but after you get your mortgage, you got to figure out how to pay it. So we're going to skip the mortgage part and we're going to go straight to payment and maintenance costs. You really need to hack your housing. You really need to look at how can I reduce my monthly expenses. And the best way to do that is to get more money, and the best way to do that is to share your home with other people. I would recommend looking for a house where you can remodel it and split it into 2 or more units. That way, your family can live in one part of the house, and then you can rent out the home to other people that can live in it. Those other people are going to pay for things like your property tax, maybe help pay for insurance, and hopefully help pay for the mortgage as well, right? So that's going to really help you. The mortgage companies are more than happy to loan you more money than you can really afford. In other words, they're able to give you these really large loan values, but the amount of cash that you need to pay every month in order to maintain that loan is actually more than you can probably afford. Because remember, you got to pay for property tax and you got to pay for upkeep of the home. Here in the Seattle area, I typically budget about 1% of the home in terms of annual maintenance costs. So if I bought a home for $800,000, I'd be spending, $80,000 annually for upkeep. That includes replacing hot water heaters, fixing roofs, lawn landscaping, and maintenance, stuff like that. It is expensive. We've got to replace in our home right now some windows, and those are not cheap. So your actual percentage of how much you need for maintenance may differ in different areas. If you are in an area with homes that are lower priced, say in $100,000 or $200,000 range, you're probably going to need to budget more as a percentage of that purchase price towards maintenance. A $200,000 home may need 3% annually, 3% of the purchase price annually in order to maintain that home. So a $200,000 home may need $60,000 in order to maintain it. The other thing that you got to think about is as home prices rise, which they've been doing, especially in some of these suburban areas, right outside of major metros, property taxes go up. And those property taxes can go up quite a bit. And as those property taxes go up, as your home value increases, it's an expense, a drag that you may have never imagined. So that's why it's always a good idea to get renters in your home and be able to pay for some of this stuff. Why? Because the renters won't just defer the payments. The rent will actually keep up with the rises in the home price. In other words, as your home price rises, you can actually start charging more and more rent. As your property tax goes up, you can start charging more and more rent. In other words, you have built into your home a way to defer some of these rising costs. So that's the great thing about renting out part of your home. Not only does it help you pay for your home, but it actually helps you insulate and protect your family against some of these rising costs. All right, so how would you actually do this? Well, you would buy a home and you'd look for a place that has the electrical, the water, and some of the hookups that you could easily create 2 units out of it. Typical example would be a basement. You have an unfinished basement, it's got, water, and it doesn't have heat. So what you need to do is, you need to hook up sinks and bathrooms. You would need to finish off some of that stuff if it's not there. And then for heater, you need to get a space heater, or you need to get one of those heat pumps or another heat unit that you can drop in. They have some really nice independent units that are just electrically powered that you can mount onto walls, but they will need ventilation. So you're going to have to look into that too. If you can finish out your basement, you actually have a really nice living space now. And, depending on where you are income-wise, you can choose to have your own family start off in a smaller basement area while you rent the rest of the house to renters. And those renters, because they have more square footage, are going to be paying more. And because they're paying more, they're going to be paying the majority of the housing costs. Now, the great thing about this is when you're explaining to your in-laws or your friends and family who are borrowing money, and you're explaining how you're going to hack this and how you're going to live in a small part of the house and rent out the larger part of the house, that will explain and give them confidence that you're going to be able to pay back some of the money that you borrowed for that initial down payment. And the amazing thing about a home as an investment is it's one of the few things that everybody can have a leveraged interest in. It's one of the few places where you can borrow money in your investment. If you're putting 10% down for your home, it's 90% that's paid for by a loan. That's a 1 to 10 ratio. That's pretty good, right? So as your home goes up just a little bit in value, you're reaping all those benefits from appreciation, but you don't have to pay for it up front, right? And oftentimes you get a fixed loan, so your loan stays the same. Your loan amount stays the same based on your purchase price with a fixed annual interest rate. So as the home appreciates, you can reap some of those benefits without having to, in a leveraged way. So if your home goes up by $100,000, you capture that $100,000 even though you only put down 10%. You buy a home for $800,000, you put down 80 grand, right, for your down payment. Sure, you're paying your monthly interest payments and it goes up by $100,000 to $900,000. You just invested $80,000 plus your mortgage payments and you are now $100,000 richer. Your net worth went up quite a bit with this smallish size investment. So if you're able to manage the cash flow, if you're able to manage the cost of your mortgage payments and your maintenance costs, then your home will appreciate. It may not appreciate a lot, but just a little bit of appreciation because of the way that you're leveraging your home, you will see benefits, you will see a growing net worth. Now, it is possible for home prices to drop, and we saw that in 2008, but if you can keep renters in your home and continue to make those payments and you have some emergency savings saved up, you should be able to, go through any periods where you're not able to find any renters. And you should be able to last for enough time for the housing market to recover and the rental market to recover as well. There's another benefit to taking a small part of your home, like your basement, living in it while you rent out the larger part of your home. And that is, as your family grows, you can actually do a flip-flop. If your family grows and you have 2 kids, when your renters who are renting out the larger part of the home leave, you can move into that larger part of the home and then you can rent out the basement. Hopefully by that time, you've grown, you're in your career, you're getting paid a little bit more. You may not need the same rental income that you did before because you're getting more income from other sources. Well, you just move into the larger part of your home and rent out the smaller part. The reason that this is great is because of the transaction costs involved in real estate. You're looking at, stamp taxes, county taxes, and then agent fees. So, you buy a home for $700,000-$800,000, you could easily be looking at $15,000-$20,000 of closing costs. If you don't have to move, you're just moving into a different part of your own home, you're going to save all that money. You're going to save all those closing costs. And you're not going to have to pay for moving expenses, and you may not. And if you move into a home, usually there's some deferred maintenance, or as soon as you move into a home, something always breaks. You don't have to go through that either. So there's a lot of advantages to buying a bigger place, being able to rent out the majority of it, and then as your family grows, being able to move into the larger section by still renting out the smaller section. And then if your career continues to progress and you continue to make more money, maybe you don't have to rent out your home at all. It's up to you on how you want to manage your finances and what you want to do. But it is always nice to have that additional rental income, because as I mentioned, that rental income will keep up with rising costs. Okay, so the last part is getting the actual mortgage. So we're aiming for like 10% down payment because homes are super expensive. I think there are quite a few lenders that will go for 10% down payment. Now the important thing is, if you're getting money from your friends and family or from your in-laws in order to make that down payment, you need to do that first. You need to make sure that you have that agreement in place, you get the actual cash, and you get it transferred into your bank accounts for at least 90 days. Why? Because when you go and apply for the mortgage, they're going to ask you for, probably 3 months, maybe it's 1 month, depending on the lender. They're going to ask you for your bank statements. And so what you want to see is that money in your bank account for 3 months. That way, they'll see that you have enough money for your large down payment, this $80,000 down payment, $80,000 down payment for an $800,000 home, and they'll be able to approve the mortgage. What you don't want to do is you don't want to walk in and try to get approved for a loan and not have the money for the down payment. And then if you try to explain to the lender that these other people are going to be giving you money to help you pay for the down payment, that's a difficult situation to explain, and the lender might not think you're as financially stable as you want them to think you are. So I recommend that the first thing you do is target the amount of house that you're going to afford, make sure you have that 10% down payment, borrow money from your friends and family, and have that money sitting there for 3 months. Now, if it's sitting there for 3 months but you're not yet able to buy a home, what you may want to do is say, hey, my first, interest payment or whatever my first payment is going to cover the first 4 months. I'm going to pay you once, then I'm going to have pause it for 3 months, and then we'll start the payment schedule again. The reason you want to do that is because obviously your money's sitting there for 3 months and it's not doing anything, so why would you want to pay for it, right? So you want to make sure that you have, in your agreement with people that are loaning you money, the ability to get this money in a timely manner 3 months before you apply for the loan, and you want to make sure that you have agreements in place where you don't have to pay for that money even though it's sitting in your bank account. The last thing, if you're looking at a mortgage, is to understand what your credit score is. You don't have to get too caught up in exactly what number you are, because basically the companies break you down into different categories. If you have a FICO score of I think it's 690 or above, you've got great rates. So how do you figure that out? Well, a lot of banks and credit card companies will give you that number for free. So you should be able to go to your credit card company or go to your bank and see if they offer a way to check your FICO score for free, free credit reports. Another thing that you can do is there's a free app that you can download from Capital One called CreditWise. I use it quite a bit. It's great. That will also give you a credit score. The only thing I have to caution is that credit score is the Vantage credit score. It's not the FICO credit score. So the score that you get from the CreditWise app could be slightly different than your FICO score, which means it might be slightly different than the score that your lender sees. Just to keep that in mind. So if your credit score is 690 and above, you're great. Don't worry about it. If it's in the 400 or 500s, then you might want to think about postponing your purchase of a house and waiting until you can build up your credit score. If you use these apps like CreditWise or the credit reports that you get from your banks, they'll usually tell you what you need to do to fix your credit. They'll usually tell you the things that you need to do to put things back in action. And there also may be inaccuracies on your credit report as well. Things that are like liens that are against you that have been paid off and they're all settled, or long or debts that were charged to you when it was never you, as a case of mistaken identity. So you can look for those as well. I hope this helped. I would say the secret ingredient to all this and buying a home that is probably more than you can afford is house hacking, is getting a portion of your home, fixing it up so you can live in it and you can rent out the other half to other people. There are even companies out there that will Airbnb a room for you. They'll come in and put a lock on your door and you can Airbnb out your room if you want. That's great. I would recommend just going with a full-on rental route, because if you're renting to people, you get to approve them, you know who they are, you get to do the checks that you want to check and meet them. Well, if you're going through a third party, like Airbnb, there's people that are coming in that you may have never met. They've just signed up on the platform. And so that might be a little bit hard for some families, depending on what your trust level is with strangers that are coming in. On the other hand, if you're open to it and you have people that are coming from all over to rent a bedroom in your home, it could be a great experience because you get to meet people from all over the world and you get to meet new people, and it could be a lot of fun too. So that's another option. But I would say that is the key. Looking at a home, not just for your own family, but being able to split the cost by renting out a portion in any manner that you can figure out, whether it's renting out a small part of the home while you live in another part, buying a duplex, or even just renting out rooms on Airbnb. There's lots of options out there, but you would need to look at it and run the numbers to figure out what is going to work best for your family. But that would be my number one recommendation if you're trying to buy a house when home prices are oh so high.